Throughout its history, America has experienced several financial crises that affected the economy and people's lives. Some of these crises include the Great Depression in the 1930s, the savings and loan crisis in the 1980s, and the 2008 financial crisis. In this video, we'll take a closer look at all the most recent events, explore what caused them, and analyze how they impacted different groups of people in America and all over the world. Make sure to watch the video till the end, because we'll compare these crises to previous banking failures to gain a better understanding of how they fit into the broader picture of American financial history. By the end of this video, you'll have a better understanding of the complicated factors that contributed to these significant moments in our country's past. So, let's begin with the Silicon Valley Bank collapse. Introduction. Silicon Valley Bank, SVB, is known for providing banking services to startups, venture capitalists, and technology companies. SVB has been around since 1983 and is recognized for its specialization in serving the unique needs of the technology and innovation ecosystem. SVB is the 16th largest bank in the United States and holds a significant position in the financial sector, particularly within innovation-driven industries. Its clients range from small startups to large multinational corporations. Beyond traditional banking, SVB offers financing solutions, investment banking, asset management, and strategic advisory services tailored to the needs of technology-focused businesses. The bank's focus on the Silicon Valley region, as well as other innovation hubs across the United States and around the world, highlights its commitment to supporting entrepreneurship and innovation. SVB's role in providing financial support and expertise to startups and high-growth companies has significantly contributed to the growth and success of the technology sector, which has led to the creation of new jobs. In the financial sector, SVB is unique as a specialized bank, catering to the needs of the technology and innovation ecosystem. Its expertise in understanding the unique challenges and opportunities facing technology companies has made it a trusted partner for entrepreneurs, investors, and industry stakeholders. Timeline of events leading to the Silicon Valley Bank collapse. Silicon Valley Bank was closed down by federal regulators due to a series of events that raised concerns about the bank's stability. Here's a simple timeline to understand what happened. 1. Warning signs. Reports suggested that SVB was exposed to risky assets and was struggling to maintain adequate reserves. This raised concerns about the bank's stability. 2. Regulatory scrutiny. The authorities started investigating the bank's operations and found compliance issues and risk management deficiencies. 3. Market turmoil. The bank faced challenges due to disruptions in the technology sector and shifts in investor sentiment. This made it vulnerable to market fluctuations. 4. Bank closure. On March 10, 2023, federal regulators announced the closure of SVB due to concerns about its financial viability and ability to meet its obligations. A combination of warning signs, regulatory actions, and adverse market conditions led to the collapse of Silicon Valley Bank, which was a significant event in the financial industry. Causes of collapse. The Silicon Valley Bank is said to have collapsed due to a range of factors, both internal and external, that put a lot of pressure on its operations and financial stability. Here are some of the key reasons behind its collapse. Number 1. Increase in interest rates. The Federal Reserve's decision to raise interest rates made it more expensive for SVB and its clients to borrow money. This impacted the bank's ability to make money and affected its financial stability. The bank relied a lot on short-term financing to support its lending activities, which became more challenging as borrowing costs rose. Number 2. Management issues. SVB struggled with internal management problems, such as poor risk management practices and inadequate capital reserves. This exposed the bank to excessive risk, making it vulnerable to economic downturns and market fluctuations. The bank did not address these issues promptly, which worsened its financial situation and led to a loss of investor confidence. Number 3. Economic pressures. External economic factors, such as market volatility and disruptions in the tech industry, also contributed to SVB's collapse. The bank was heavily invested in the tech industry, which made it susceptible to shifts in investor sentiment and economic slowdowns. Additionally, the collapse of other banks in the industry added to the systemic risks and further strained SVB's financial position. The collapse of Silicon Valley Bank was caused by a combination of factors, including higher borrowing costs due to interest rate hikes, management issues, and external economic pressures. These factors created a difficult environment for the bank, ultimately leading to its failure. Impact on stakeholders. The collapse of Silicon Valley Bank caused a lot of problems for many different people and the financial system as a whole. Here's what happened. 1. People who had put their money in the bank, called depositors, were worried they might lose their savings. Some people were protected by the government, but others weren't, so they were in danger of losing their money. 2. People who had invested in the bank, like the people who owned it, and other financial companies lost a lot of money. The value of their investments went down a lot, which made them very upset and worried about the future. 3. The people who worked at the bank were affected too. Some of them lost their jobs, and others didn't know what they would do next. It was a very difficult time for them. 4. The collapse of SVB made a lot of people worried about other banks too. They weren't sure if other banks might fail too, which could be bad for the economy. The collapse of SVB caused a lot of problems and showed how important it is for banks to be careful and manage risks well. Comparison to previous bank failures. Silicon Valley Bank's collapse was a significant event in the United States banking history. It's worth understanding how it compared with other notable bank failures to see the similarities and differences between them. During the Great Depression in the 1930s, many banks failed due to economic problems and a lack of good supervision. This caused depositors to lose confidence in the banks, leading to panic and bank runs. This was similar to SVB's collapse, but the difference was that many smaller banks failed during the Great Depression, whereas SVB was a large bank itself. The savings and loan (S&L) crisis of the 1980s was caused by risky lending practices and poor regulatory supervision, and it involved the failure of many financial institutions, causing significant losses to depositors and taxpayers. SVB's collapse was caused by broader financial mismanagement. The 2008 financial crisis, triggered by the subprime mortgage crisis and the collapse of Lehman Brothers, had a significant impact on the financial system. Both the 2008 crisis and SVB's collapse highlighted weaknesses in risk management practices and regulatory oversight. However, the causes of the 2008 crisis were more complex, involving toxic mortgage-backed securities and financial instruments. The government's response and regulatory reforms that followed also differed from the response to SVB's collapse. In contrast to some historical bank failures where regulatory responses were often reactive, SVB's collapse prompted swift action from regulatory authorities. The Federal Reserve and other regulators intervened to stabilize the financial system and prevent contagion. This proactive approach reflects lessons learned from past crises and underscores the importance of early intervention to mitigate systemic risks. The market conditions surrounding SVB's collapse, such as rising interest rates and economic slowdown, were similar to some aspects of previous banking crises. However, the specific economic factors and regulatory environment leading up to SVB's collapse may differ from those of previous crises, highlighting the unique circumstances and vulnerabilities that contributed to each financial disaster. Understanding how SVB's collapse compared with other bank failures can provide valuable insights into the dynamics of financial crises and inform efforts to strengthen regulatory frameworks and risk management practices in the banking sector. Lessons learned and future implications. The recent collapse of Silicon Valley Bank highlights some important lessons and implications for the banking industry, financial regulations, and the stability of the financial system as a whole. Firstly, banks need to have better ways of identifying and managing risks, such as credit, liquidity, and operational risks. This can help prevent catastrophic failures and make sure that banks are better prepared if something goes wrong. Secondly, regulatory bodies need to monitor banks more closely and update their regulations regularly to prevent systemic failures. This can help improve transparency, accountability, and resilience in the banking sector. Thirdly, banks and other financial institutions need to be more transparent about their activities, so investors can make informed decisions and assess risks better. This can help prevent market disruptions and reduce information asymmetry. Fourthly, there needs to be a better way to assess and address potential threats to financial stability. Regulatory authorities should work with market participants to identify risks and implement effective risk management measures to prevent systemic crises. Fifthly, it's essential to have investor protection measures in place to safeguard depositor funds and prevent market disruptions. This can be achieved by establishing robust deposit insurance schemes and resolution frameworks. Finally, it's important to have adaptive monetary policy frameworks that can address evolving financial market dynamics. Central banks should calibrate monetary policy tools to support financial stability while promoting economic growth. By addressing these lessons and implications, we can enhance the resilience and integrity of the global financial system, reduce the likelihood of future crises, and promote sustainable economic growth. Conclusion. The recent collapse of Silicon Valley Bank has some important lessons for everyone, not just bankers. The collapse of SVB shows us that banks need to be very careful with how they manage risk. They need to be transparent about what they're doing, and regulators need to keep a close eye on them. We also need to think carefully about how we protect investors and make sure that our monetary policies can adapt to changing circumstances. The collapse of SVB has had some serious consequences. Shareholders have lost money, and people who put their money into the bank may have trouble getting it back. The collapse has also shaken people's confidence in the banking system, which could make things more unstable. The reasons for the collapse are complicated, but basically, the bank took on too much risk and didn't have enough money to cover its losses. This made it vulnerable to problems in the market, which ultimately led to its downfall. People who invested in the bank lost a lot of money, and people who had money in the bank may have had trouble getting it back. What do you think caused the Great Depression in the 1930s, the savings and loan crisis in the 1980s, the 2008 financial crisis, and the collapse of Silicon Valley Bank? Share your opinion in the comments section below. It's important to understand the reasons behind these events, and your input can help shed light on the matter. Don't forget to hit the like, share, and subscribe buttons for more interesting discussions on finance-related topics that affect our lives.